Imagine a world where the stock market crashes and while everyone is panicking, one man is calm and collected. That man is Warren Buffett. How does he do it? Welcome to Fun Financial Insights, where we dive into the strategies of the world's most successful investors and uncover the secrets behind their decisions. Today, we're focusing on the Oracle of Omaha himself, Warren Buffett, and his intriguing approach to navigating potential market crashes. As of the first quarter of 2024, the conglomerate is sitting on a mountain of cash amounting to a staggering $189 billion. This isn't a small increase. It's a leap from the $167.6 billion during the last quarter of 2023. So what's the story behind his financial fortress? Warren Buffett, the mastermind behind Berkshire Hathaway, has always advocated for a war chest that's ready for battle. The company's philosophy is simple: be prepared. With such a cash reserve, Berkshire Hathaway can move swiftly and decisively in times of economic turmoil, snapping up undervalued assets while others are still tying their shoelaces. Looking back, Berkshire Hathaway's cash on hand has seen some fluctuations. In 2021, it was at an impressive $88.184 billion, but by 2022, it had dipped to $35.811 billion. Fast forward to 2023, and it climbed back up to $38.022 billion. These numbers are a reflection of Buffett's strategic thinking and market anticipation. Why such caution? Well, Buffett knows that the market can be a roller coaster, and he prefers to ride it with a safety net. By maintaining a substantial cash reserve, Berkshire Hathaway ensures it has the liquidity to manage its insurance operations and other business ventures without breaking a sweat. It's like having a financial Swiss Army knife ready for any scenario. Now let's turn the tables and ask you a question. If you were at the helm of Berkshire Hathaway, how would you utilize this cash reserve? Would you invest aggressively, wait for the perfect opportunity, or do something entirely different? Share your strategies in the comments below. And let's see how they stack up against the Oracle of Omaha's playbook. Hey, don't miss out on the rest of our deep dive into the financial strategies that have stood the test of time. Hit that subscribe button. Stay tuned as we reveal the metrics that Buffett swears by and how you can apply them to your own investment strategy. We're about to dissect the Buffett Indicator and its uncanny ability to predict market movements. Plus, we'll explore the enigmatic world of Treasury yield curves and what they signal about the future of the economy. This is where finance gets fascinating, so keep watching. In the world of investing, cash is king, and no one knows this better than Warren Buffett. His conservative strategy of maintaining massive cash reserves is a testament to his investment philosophy. Be fearful when others are greedy, and be greedy when others are fearful. So why does Buffett insist on such a large cash buffer, and what are the reasons behind this fortress of liquidity? Well, Buffett's prudence is legendary. He believes in the power of cash to provide options and security in a market downturn. When stocks plummet, those with cash can purchase valuable assets at a fraction of their cost. It's like going shopping during the biggest sale of the century, and only those with cash in hand can truly take advantage of the discounts. Let's look at the numbers. During the 2008 financial crisis, while many companies were struggling to stay afloat, Berkshire Hathaway's cash reserves allowed it to invest $5 billion in Goldman Sachs and $3 billion in General Electric, securing favorable terms and high-yield dividends. These moves not only provided Buffett with significant returns, but also reinforced the strength of his cash reserve strategy. The rationale behind Buffett's approach is twofold. Firstly, it's about risk management. With enough cash on hand, Berkshire Hathaway can withstand any short-term market fluctuations without the need to liquidate assets at a loss. Secondly, it's about being opportunistic. Market downturns are rare opportunities to buy premium stocks at bargain prices, and Buffett's cash reserves ensure he's always ready to pounce. Let's shift our focus to a cornerstone of his investment philosophy, Treasury Bonds. These are the bedrock of conservative investment portfolios, offering a unique blend of safety, steady income, and liquidity. Treasury bonds, or T-bonds, are long-term fixed income securities issued by the U.S. Department Department of the Treasury. They are the government's way of borrowing money to fund various public expenditures. When you buy a T-bond, you're essentially lending money to the government, which promises to pay you back with interest over a period of 20 to 30 years. Buffett values T-bonds for their safety and security. The historical default rate for U.S. Treasury bonds is effectively zero, making them a reliable safe haven for investors. They offer a dependable income stream through fixed interest payments known as coupon payments, which are made semi-annually. In times of market volatility, T-bonds shine as a hedge against risk. They provide stability and security that can offset losses in other areas of a portfolio. This is particularly appealing to conservative investors. One of the main disadvantages of investing in U.S. Treasury securities is their liquidity. If an investor needs cash, they can liquidate their T-bonds without significant delays or complications. This easy access to liquidity is a critical factor in Buffett's strategy, allowing him to remain agile in his investment decisions. Coming up, we'll take a look at some of the metrics that guide Buffett's market evaluations. Now let's turn up the heat and review some insights with the Buffett Indicator, a metric that Warren Buffett uses to evaluate the temperature of the markets. This indicator is like the thermometer of the financial world, and right now it's showing us that things might be getting a little too hot. The Buffett Indicator is the ratio of the total United States stock market value to the gross domestic product, GDP. It's calculated as follows. Buffett Indicator equals gross domestic product, GDP, total U.S. stock market value. As of March 31st, 2024, the total U.S. stock market value stands at a colossal $55.84 trillion, while the annualized GDP is $28.28 trillion. This puts the Buffett Indicator at 197%, suggesting that the stock market is strongly overvalued. What does this mean? Well, when the stock market value grows much faster than the actual economy, it can be a sign that we're in a bubble. And just like bubbles in a fizzy drink, the bigger they get, the more likely they are to burst. The current ratio of 197% is approximately 60.88% above the historical trend line, indicating that the market might be due for a correction. When we decode the Buffett Indicator's past, it reveals a pattern of peaks followed by significant market corrections. For instance, it reached its zenith right before the dot-com bubble burst and the Great Financial Crisis. In 2021, the indicator hit an all-time high, which was succeeded by a year of continuous decline in stock prices. This pattern shows the indicator's predictive power. The long-term average value of the Buffett Indicator is a bit less than 100%. When the ratio exceeds this average by a considerable margin, it has often signaled an overheated market. For example, a level above 132.7% has been a hard-to-ignore warning sign for market downturns. While the Buffett indicators signal a lot, there are also other things to take into consideration. We'll explore the implications of interest rates and the Treasury yield curve on the market, and how they tie into the Buffett Indicator's forecasts. Interest rates are the cost of borrowing money. They are determined by the Federal Reserve and can have a profound impact on the economy. When rates are low, borrowing is cheap, encouraging spending and investment. Conversely, high rates can cool down an overheated economy. On the other hand, the Treasury yield curve is a graph that plots the yields of U.S. Treasury securities at different maturity rates. Normally, long-term bonds pay more than short-term ones, reflecting the risks of time. However, sometimes this curve inverts. An inverted yield curve occurs when short-term interest rates exceed long-term rates. This unusual situation is a historical signal of economic downturns. As of May 24, 2024, the spread between the 10-year and 2-year Treasury yields was negative 0.47%, indicating a significant inversion. In the past, an inverted yield curve has been a reliable predictor of recessions. It has predicted every U.S. recession since 1955, with a typical lead time of 12 to 18 months. The current inversion has been the longest in history, lasting over 625 days. The Federal Reserve, or the Fed, has a powerful tool at its disposal to fix some of these concerns, the ability to adjust interest rates. As of May 2024, the Fed has kept the interest rate steady at between 5.25 and 5.5%, the highest level in over a decade. This decision is part of a broader strategy to manage inflation, which remains a persistent challenge for the economy. When the economy shows signs of slowing down, the Fed can lower interest rates to stimulate economic activity. Lower rates make borrowing cheaper, encouraging businesses and consumers to spend and invest more. This injection of capital can help jumpstart economic growth. Lowering interest rates has a ripple effect on the bond market, particularly on long-term bonds. As rates drop, the value of existing bonds with higher interest rates rises. This is because new bonds are issued at the new lower rates, making the older, higher-yielding bonds more attractive to investors. When the Fed lowers interest rates, the price of long-term bonds tends to increase. For example, during the last rate cut cycle, the price of 30-year Treasury Bonds increased by an average of 4%. Even though there is a high likelihood of a downturn, the possibility of the Federal Reserve lowering interest rates is a critical factor for you as a bond investor to consider. It can lead to an increase in the value of longer-term bonds, providing a potential opportunity for you to capitalize on market movements. What makes a market stable using the metrics we've discussed, and how can you leverage them to your advantage? Well, a stable market is characterized by balanced growth, moderate inflation, and sustainable valuations. To identify such a market, savvy investors like Warren Buffett look at a combination of metrics, including the Buffett Indicator, interest rates, and the yield curve. As we've seen, the Buffett Indicator provides a snapshot of market valuations. A stable market would typically have a Buffett Indicator close to its historical average, suggesting that stock prices are in line with economic growth. Stable markets also often feature moderate interest rates that balance the need for economic growth with the control of inflation. Now, how can you leverage these metrics? Well, here's a strategy. Diversify. In a stable market, diversify your portfolio across different asset classes to benefit from steady growth. Long-term bonds. Consider long-term bonds for consistent returns, especially when interest rates are expected to decrease. Value stocks. Look for value stocks with strong fundamentals that may be undervalued according to the Buffett Indicator. As we wrap up this episode, let's reflect on the enduring wisdom of Warren Buffett and the strategic fortress of cash reserves he maintains. It's a financial moat that not only protects but also empowers Berkshire Hathaway to seize opportunities when others are constrained by the tumultuous tides of economic crises. Economic downturns are inevitable, but preparation is a choice. Buffett's strategy teaches us that having a cash reserve is not just about survival, it's about being able to thrive in adversity. It's a reminder to all investors that the true measure of financial acumen is not just in riding the highs, but in weathering the lows with grace and strategic insight. If you're inspired by Buffett's approach and want to build your own financial stronghold, don't forget to hit that subscribe button.